Welcome to NDR Signal Exchange, your go-to source for insights on the markets and economy. In under 5 minutes, we'll answer your top questions and cover key trends shaping the financial markets. I'm Ed Clissold, NDR's Chief U.S. Strategist, and I'll be covering a recent client question on when we will downgrade our long-term bullish outlook on the U.S. stock market. We have been overweight stocks in our U.S. asset allocation framework for over 2 years. And we remain overweight because, well, the drivers of the bull market remain intact. And the three main drivers are disinflation, earnings acceleration, and strong technicals. Now, the challenge as we go deeper into 2025 is that each of those are going to be coming under threat. So we'll talk about each of those in turn. First of all, disinflation. The drivers of disinflation have been housing slowing down, and in particular, goods deflation. We have returned to the pre-pandemic era of importing deflation from overseas. The second half of the year, it's possible that rent prices could go up because of a lack of new supply of apartments coming onto the market. And then, of course, tariffs are the wild card on the goods side of things. So we have an indicator that looks at the CPI versus its 6-month moving average. When the CPI is below the 6-month average, that's bullish for stocks. That started in September of 2022, right before the market bottom, and remains on a disinflationary track. If inflation moves back towards 3%, like our macro team thinks, that could come under threat. The second thing is earnings acceleration. So over the course of, in particular, 2024, earnings growth was faster each quarter than it had been the year prior. That's going to be challenged this year, in particular because of the Mag 7. Just the law of large numbers means that their earnings growth could fall from like a blistering pace of over 54% as a group down to 38%. Now, the other 493 stocks are catching up. They're going from -2 to maybe +6. Is that going to be enough to keep earnings growth accelerating year over year? That could be challenged, but that's also more of a second half issue, we think. And then thirdly, there's been a misnomer out there that because of Mag 7 have outperformed, most stocks are struggling. That's not the case. For most of the last 2 years, well over half, in a lot of cases, over 2/3 of stocks have been above their long-term or 200-day moving averages. That's still the case now. Now, what we've noticed, though, is that the percentage has drifted low over the past couple of months. Also, things like the advanced decline line, a running total of stocks up on the day of down the day, that peaked back in November. Percentage of stocks at new 52-week highs peaked way back in July. Now, a lot of these so-called technical divergences where these breadth numbers get worse, even though the popular averages are making new highs, these crop up and they resolve themselves bullishly quite often. But almost every market top has been led by these divergences. So we have to keep these in mind. So there's a very plausible scenario as we get to the second half of the year that inflation's ticking higher, earnings growth is slowing, and the technicals are looking a lot worse. And if that's the case, it's going to be very difficult for us to maintain our overweight allocation of U.S. stocks. I want to emphasize at the end here, we wait for the data to change. I'm not going to change my allocation because I think something might happen. We wait until the data tells us it is happening. So we remain overweight stocks for now. If you have any more questions or want deeper analysis, feel free to submit your own questions for the next episode by emailing neddavisresearch@ndr.com. Thanks for watching NDR Signal Exchange. Let NDR help you see the signals.